Good afternoon, boys and girls. I'm Raymond Dahlman. This is the Liberty Call for Wednesday, December, February 2nd, 2022. I hope everyone's having a fantastic day out there. It is a bit snowy, so let's go ahead and take a moment. And we'll go outside and take a look at the weather. So hang on one second. All right. So let's go outside and take a look at the snow. Whew. It's pretty deep out here. You can see the little glacier that's building up over here in front of my house, and the truck's got probably 4 or 5 inches on top of it. So we got this snow the rest of the day. So if anyone wants to come out here and help me shovel, I'd greatly appreciate it. All right, let's go back in. All right. All right. Stream. There we go. All right. Let me remove that. There we go. All right. So let's take a look and see how the markets have done now that we've gotten our weather report in for today. All right. Dow Jones was up 0.63% today to close at 35,629. The S&P 500 up 0.94%, closed at 4589. NASDAQ up 0.5% to close at 14,417. Small caps were down about 1%. The VIX slightly up about 0.59%, closed at 2209. Let's see, across Europe, mostly green, except for the Eurostoxx 50 and the IBEX 35. As we get down towards the Asian markets, kind of mixed. Seeing about half and half until we get over into Asia, China and that area. That's mostly red, except for the Hang Seng, which came in slightly over 1%. So, if we were to look at the day, it was mostly down in the Asian overnights, mostly up across the Europe early this morning, and then today here domestically, mostly green. So pretty good. So I can honestly say that we've had a couple days where it's kind of calmed down. The VIX has come down close to 20. So all in all, not too bad. So. Right. So I got a few articles I want to blaze through. Some of these aren't too long. First one, U.S. oil stockpiles down over 1 million barrels last week. All right. This came from Sam Buheda. Sorry, Sam, if I mispronounced your name. U.S. oil stockpiles dropped 1.046 million in the last week. The Energy Information Administration said Wednesday. Crude inventories came in at 1.046 barrels in the negative last week, compared with the analyst expectations that we would build up 1.525 million barrels. So that's about 2.5 million barrels off as far as the analysts. So it's one thing to be, if it was going to be up slightly and it came in down slightly, that wouldn't necessarily be a big deal, but that's pretty bad. Distillate stockpiles, which include diesel and heating oil, were down 2.411 million barrels in the week against an expectation of a draw of 1.492. So it was over by about 1 million barrels there. And gasoline inventories increased by 2.119 million barrels compared to an expectation of a build of 1.645. So that's the one where the inventory actually was greater than expected. But even still, that was probably by close to 500,000 barrels. So all in all, not a good week if you're that analyst or group of analysts who are supposed to be the educated guessers out there. All right, next article. U.S. dollar falls on weak private jobs data. Euro up as inflation perks up. It's written by Gertrude Chavez Dreyfus. From Reuters, the dollar declined to more than a 1-week low on Wednesday after data showed a drop in U.S. private sector employment in January due to the increase in COVID-19 infections. How do they know that? I mean, just let me pause there. How do they know that COVID-19 infections were the reason for the loss in jobs? I mean, normally when you excuse me while I nose is running. I mean, normally when you're out of work or off work for COVID-19, you don't normally quit. So, anyways, all right, let's jump back in. However, the data is unlikely to prevent the Federal Reserve from hiking interest rates at the March 15th, 16th policy meeting, but the report has eased expectations of a large interest rate increase of 0.5 percentage point. And the people in the powers that be, or they, I hate using that term, but there's a large group of people who run things who are not in favor of interest rates going up. It seems to, just from my own perception, that they would prefer to keep interest rates at zero, continue to borrow at next to nothing, and rake in profits. And then if they screw up and run the company into the ground, Uncle Sam will come bail them out. All right. In contrast, the euro gained for a third consecutive day, coming off a 20-month low last week as Eurozone inflation rose to a record high last month. That fueled bets the European Central Bank could raise interest rates sooner than expected. The dollar index, with the euro as the largest component, fell 0.3% to 95,926. It's on track for its largest weekly percentage loss since November of 2020 at 1.3. ADP reported on Wednesday that U.S. private payrolls dropped by 301,000 jobs last month. Data for December was revised lower to show 776,000 jobs added instead of the initial reported 807. Economists polled by Reuters had forecast an increase of 207,000 in private payrolls. Markets are well prepared for an Omicron-driven drop in January payrolls, and in recent days, a number of Fed officials have signaled comfort with the underlying economy's direction, said Carla Shamoda, chief market strategist at Cambridge Global Payments. Until financial conditions tighten meaningfully, the Fed will retain a hawkish bias and momentum should support the dollar. A peak is coming, but we're not quite there, he added. In late afternoon trading, U.S. futures priced in about a 4.7 hikes this year, or 118.6 basis points of policy tightening, down from the 5 rate increases seen over the last 2 days. God, they are really trying to push that back in another direction to keep interest rates low. So, I mean, I don't know if you're the only one seeing it out there. I mean, the few people who actually watch me ramble for 20 minutes a day, but there seems to be a concerted effort by people in the media and those that work with the Fed or are spokespeople for the Fed that we really don't want to do too many rate hikes. I mean, inflation is 7%, or at a minimum. What is it? 1 or 2% in interest. I mean, you still have a negative interest rate, or you have negative inflation, or not negative inflation. You're still losing 6%. If you get 1% in interest and 6% in inflation, you're still losing a significant amount. All right. Well, let's go ahead and jump over to the next article. If you want to finish reading that, it's in the show notes, so you can read that at your leisure. U.S. Yield curve inversion may be false positive recession signal. Credit Suisse. This comes from Reuters as a U.S. Treasury yield curve inversion this time around may not be the perfect predictor of a recession, a Credit Suisse strategist said on Wednesday, as the Federal Reserve focus on reducing inflation could take priority over economic growth concerns. Reflecting the U.S. Central Bank's plan to hike interest rates, short-term government bond yields have risen more than long ones this year, flattening the curve. A curve inversion, particularly one determined by comparing the 2-year and 10-year Treasury bonds, has in the past presaged recessions, as the market priced in expected rate cuts based on possible monetary policy actions that could damage the economy. Credit Suisse trading strategist Jonathan Cohn said that part of the curve, which has flattened this year but is not close to inversion, is currently consistent with roughly 25% probability of a recession in 2 years' time, but economic conditions this time could prevent the curve from presaging a slowdown. Contrary to the last several periods in which the curve inverted, the current economic backdrop leaves policymakers in a more precarious position, one in which costs of underreacting to inflation may be significantly greater than overreacting, he said. Pressure on long-dated yields caused by several factors, including excess savings, may foster an environment in which curve inversion may more likely be a false positive recession signal and thus leave inversion a less reliable recession indicator, he said. Fed officials are monitoring the flattening of the curve, but do not view its behavior as an iron law that predicts economic outcomes, Chair Jerome Powell said last week. Fed officials have also said they would mainly use a passive approach when shrinking their balance sheet, part of a plan to reverse this year's bond buying, years of buying bonds to support the economy. That decision effectively rules out selling longer dated U.S. Treasuries, but the Fed would still have ammo to steepen the curve if needed by reinvesting bond proceeds in shorter dated debts rather than across the curve as it currently does, Cohn said. All right, let's go ahead and take a look at the yield curve. And ooh, look at that. It's bending over right there. So, looking back at the end of 2019, so here's the curve now. And going back through time, this was last summer, a year ago at this time. So this was February 9th. That's what the curve looked like. But going back prior, so this was what the curve was like at the end of 2019, which gave me a lot of worry. So you can see where it dips down and then, slowly slopes back up. According to this chart, it says it's a normal curve. I don't know how that looks normal in any stretch of the imagination, but this was in the fall of 2019. And, all my clients can tell you that I was saying, all right, this is bad news. Over the next year, I imagine we're going to go into some sort of a market, downturn, and then what happened? Well, we had COVID, come to life at the beginning of 2020. We did have a quick drop and then a massive rally, primarily due to the fact that our government just dropped money out of helicopters and, propped up the economy, the stock market and everything. And, now we're dealing with those consequences. Yeah. The government didn't collapse and the dollar didn't collapse at the time, but, it's like cutting off your nose to spite your face. Yeah, you averted a problem at the moment, while we were dealing with a cold. But, we've now dug ourselves a much, much deeper hole and we're in much, much more trouble than we were 2 years ago at this time. So anyways, my expectation is that once all the, steam that is run out of the, from propping up the economy has run its course, we're going to go through that same downturn we were headed towards, 2 years ago. So whether or not it's going to happen, the first 6 months of this year or the last 6 months of the year, I have no clue. I have no idea. All I can really do is watch the momentum of the charts and make an educated guess on what's going on. All righty. Next article, a few more stock pullbacks and then a big one are coming, warns this manager. Here's how investors should prepare. This is written by Barbara Kohlmeyer. This comes from MarketWatch. All right. A recent string of wins for stock markets, the best percentage gain since 2020 for major indexes, is some improvement on the grim start we got in 2022. But yes, it's early. And yes, the veterans are wary. Among them, Chief Investment Officer of CIBC Private Wealth US, David Donabedian. Well, that's a long name. Who in our call of the day tells investors to expect a single-digit return with 3 or 4 smaller pullbacks and then a big one. We enter 2022 with relatively high valuations, a 7% inflation rate in the United States, and the three greatest catalysts for the great bull markets coming out of from March 2020 through 2021. Donabedian told MarketWatch in an interview on Monday, he said those catalysts, monetary and fiscal policy, and an earnings boom will be less friendly this year. We're going to have to get very used to at least 5% pullbacks in the market. And at some point in the year, we're probably going to get a full-blown correction because that's just how markets work. Hey, it sounds like I just said that. It's weird. I was just talking about that. We reminded clients coming into the year that it's normal to have at least 10% correction in the course of a year. We're probably going to see that. With that in mind, he has been positioning portfolios for more cyclically sensitive sectors that enter 2022 with relatively low valuations. Smaller companies, which got pummeled in January, have been on his radar. Small caps have extraordinarily low valuations relative to large caps. And I basically said to our relationship managers, if we don't have small cap exposure for your clients, you're underweight. Drilling down further, Donna Bedian said he's seeing opportunities in the biotech space. And while there are some of the mega cap techs, he doesn't see them as a table pounding buys. Plus, those types of fairly highly valued stocks aren't the best bet for Fed tightening scenario. He's passing on beaten down meme names, which he tossed in with crypto, special purpose acquisition companies, and other speculative investments. He said investors need to understand that the environment ahead isn't going to be rising tide lifts all boats market as the Fed slowly raises the cost of money and pulls liquidity out of the market. Well-managed companies will thrive and those that aren't won't, he said. There's a Warren Buffettism about when the tide goes out, you see who's swimming naked. There's something to be said for that. It's a less forgiving macro environment for companies, said Donna Bedian. Other ways of protecting client money is doubling down on a push for inflation protection in their equity portfolios. And one way is via a diversified pool of commodities that will see a direct benefit for higher inflation. Other advice includes an underweight in traditional fixed income, but exposure to floating rate debt. But to manage your worries that investors really aren't adequately considering the implications of permanently higher rate of inflation in the economy. And by that, I mean, this is an issue that has been off the table, not even on the back burner. The new normal for inflation will likely be closer to 3.5% and for 4 years. And I think here's a bit of a sense in the market of, well, good, that's better than 7, which is the current reading. But that's a whole new world in a number of ways, and it implied that the Federal Reserve is going to have to do more to contain inflation than markets are currently expecting, and that's not this year. That's over a number of years, he said. So, looking at that, there's a little more to this if you want to breeze through it. It's, some of his recommendations and such. I personally, like I said, believe that, we're due. We were due for a massive pullback 2 years ago. We started to get it. And like I said, the Federal Reserve came in with the credit card, said, all right, I'm buying, and, seemed to solve all the woes at the time. However, it's, the inflation rate and the inflation we're dealing with now is it's inflation from Obama and Trump. I mean, we're not even dealing with Biden inflation yet. And I think that's probably going to be more like Biden's stagflation as opposed to inflation. But, we'll see. I mean, I'm just spitballing there as far as what I think will happen. All right. Last one. This is just some, good news out there or for people who are in the job market or considering a career change. The best job in America pays $145,000 and has 14,000 job openings and offers a generous work-life balance. This was written by Quentin Futrell. All right. A 6-figure salary and the option to work from home. It sounds too good to be true. The careers website Glassdoor on Wednesday released its annual 50 Best Jobs in America report for 2022. With so many workers on the move as we enter the year 3 of the pandemic, it makes for particularly timely reading. Once again, tech workers came out on top with enterprise architects #1 on Glassdoor's list. They have a median base salary of $144,997 a year, and there's 14,021 job openings and a satisfactory rating of 4.1 out of 5. Job openings are up while workers continue to quit. The number of vacant jobs hit 10.9 million in December, up from 10.6 the previous month. The job openings rate was steady at 6.8%. The COVID-19 pandemic has made people reassess their role of work in their lives. Workers are burned out and looking for better benefits, shorter commutes, higher salaries, and critically, a more accommodating work-life balance. If they spend 8 hours a day at work, they don't want to be unhappy or stressed out. Some workers, polls suggest, have gotten fed up with how their employers treated them during the pandemic and told their bosses they've had enough. Take this job and shove it. Boom, boom, boom. Wages aren't keeping up with inflation, so the only way to for most employees to either get a step up in salary is either to find a new firm or have 1 foot out the door. Scott Brown, chief economist at Raymond James. Enterprise architects whose top Glassdoor's list work in a company's IT department designing hardware, software, and networking applications. and work with stakeholders and management to help businesses achieve and maintain their digital strategy. In the last year, job openings soared and record levels of worker turnover shifted the balance of power to the worker, with large swath of employees and job seekers fine-tuning a better work-life balance, Glassdoor said in a report. So it's a pretty long article. I'm going to go ahead and stop there. So good news is, and it also has a link here in that first paragraph, the 50 best jobs in America. So if you're, fed up with where you're working or what you're doing, maybe now is the time to retrain yourself and, find it, get into a position where, like myself, I work from home. I sit here in this office, most of the day, and but it does afford me a lot of flexibility. I get to hang out with my dogs, who I have upstairs, so that they aren't making noise. And my wife works from home too. She's usually in the other office. She's in Las Vegas this week at a conference. So I mean, for myself personally, I have a wicked form of arthritis, which makes sitting for long periods of time very unpleasant. So, I mean, I have this desk, which I can stand up, when I'm doing meetings, and I can walk around. I have this, boom mic and, headphones, so that I can, stand and walk around and talk. So, I mean, I have basically built my lifestyle into my career. Now, if you're a metal bender like I was back in the Navy, you really, you can't do that stuff in your home office. I mean, I guess you could, but I don't think your spouse would probably appreciate it very much. So, I mean, yes, there's always going to be jobs where you're going to be out in the public, or, in a, a factory setting or whatever it might be, especially if you're in the trades and things like that. So, but if you're in a technology job, or a job that, where you used to sit in an office and now you can do it virtual over Zoom meetings and the like, you know what? Go ahead and do it. Granted, don't quit your job until you have either the skills or a job offer to leave for. Just up and quitting isn't always the best idea. Now, I mean, I have done it in the past, but I wouldn't recommend it. So, all right. Well, I hope everyone has a fantastic day. If anyone needs anything from me, don't hesitate to reach out via email or drop me a phone call. If there's a subject you would like me to talk about, go ahead and shoot me an email with that. I'd be happy to share it with the group. And if you're new here and it's your first time watching, be sure to subscribe and like and share. And we'll be back tomorrow with tomorrow's Liberty Call. So have a great evening. Bye-bye.